Welcome to this explainer. Today, we're decoding the highly technical mechanics of margin and, more importantly, equipping you with the mathematical armor you need to actually survive the markets. I'm absolutely thrilled to guide you through this, because mastering these specific concepts, that's literally the line between thriving and completely wiping out your account.
So let's start with a brutal reality check, one that every single trader faces. Why do so many people wipe out their accounts before they even really get going? Well, I'll tell you, it's not just bad luck. It is almost always a fundamental misunderstanding of the incredibly powerful tools they're using and the hidden risks lurking right behind the numbers. Okay, here's our roadmap for today. 1. The trader's biggest mistakes. 2. Decoding margin and leverage. 3. The dreaded margin call. 4. Stop-outs, the last resort. And 5. Bulletproof risk management. Let's get right into it. Section 1. The trader's biggest mistakes, psychology and pitfalls. An account blowout usually starts with something simple, like trading without a solid plan or letting fear and greed take the wheel. Add in a bit of over-leveraging, ignoring your risk management, or maybe over-trading just to recover from a loss out of revenge. Yeah, these pitfalls quickly snowball into an absolute disaster if you aren't careful. This right here brilliantly illustrates the sheer danger of over-leveraging. Think about this. Just a tiny 0.2% move, that's literally a 20-pip move on the Euro-USD pair, can mean total ruin when you're using 1 to 500 leverage. Sure, you might control a massive position with very little money up front, but your risk of total loss, it is exponentially magnified. There is absolutely no room for error. Moving right along to Section 2, decoding margin and leverage, the mechanics. To really grasp this, we need to strip away the jargon. The crucial point here is that initial margin is simply a deposit. Think of it as a good faith deposit that your broker locks away just to ensure you can actually meet your financial obligations. It backs your leverage, which means the rest of the trade's massive value is just market exposure, not a massive cash outlay from your own pocket. And then we have maintenance margin. This is the lower threshold you absolutely must continuously maintain as the market fluctuates and impacts your open positions. In derivative trading, this is often calculated by advanced systems like SPAN, which runs stress tests across a bunch of different scenarios to measure ongoing risk. Basically, it determines exactly what balance keeps your trade alive. Section 3. The dreaded margin call, the crisis point. Now we enter the crisis phase. The really severe distinction you need to understand here is that a margin call is just a warning, while a stop-out is a forced liquidation of your assets. A margin call is basically your broker waving a red flag saying your equity is getting dangerously thin. A stop-out, that means the broker is actually stepping in to automatically close your positions so you don't end up owing them money. What's absolutely fascinating is the precise math governing these liquidations. Your broker calculates your margin level percentage by taking your equity, which, remember, is your balance plus or minus open profits and losses, and dividing it by your used margin. Let's actually look at how this plays out in real life, step by step. Imagine you have a $2,000 account trading EUR/USD, and you're using $800 in margin. You divide 2,000 by 800, meaning you start at a very healthy 250% margin level. At this point, you're perfectly safe. No sweat at all. But let's see how this collapses. If the price drops against you, your unrealized loss grows, right? If your equity sinks to exactly $800, you hit a 100% margin level. Your equity now perfectly matches your used margin, and boom, this triggers your dreaded margin call. Now, if you ignore that call, and the loss deepens even further so your equity plummets down to just $400, well, your level hits 50%. At this critical threshold, the platform automatically steps in to stop you out. It sells off your positions right then and there to restore your margin level. Game over for that trade. Which brings us to Section 4, stop-outs, the last resort. So how do brokers actually handle these deficits? Well, according to the NFA Margins Handbook, margin calls age chronologically. On day 1, the account drops below maintenance margin. By day 2, the call is officially issued. And by day 3, it's considered outstanding. A firm absolutely must make a bona fide attempt to collect these funds, usually within a single business day, just to protect overall market integrity. Just look at how consecutive daily losses can compound. Unfavorable market movements over just a few days can result in multiple aged margin calls that demand immediate cash deposits. You really can't just wait it out and hope for the best. Ignoring them results in immediate forced liquidation.
Okay, tension relieved. Let's get to the solutions. Section 5, Bulletproof Risk Management, the armor.
Your very first piece of armor is the 2% rule. Never ever risk more than 2% of your account on a single trade. If you have $10,000, you risk no more than 200. Implementing this strict, non-negotiable rule means you can survive continuous, consecutive losses without completely blowing up your account. It's a total game changer. Furthermore, you should always aim to maintain a margin level above 300%. Treat that excess as a financial shock absorber. Normal market volatility is always going to cause your equity to swing up and down, but maintaining this high buffer keeps you far, far away from margin calls during those sudden, unpredictable price spikes. You enforce these mathematical boundaries by sizing your positions based on risk, rather than letting your available leverage dictate your trade size. Calculate your position size meticulously and always aim for a risk-reward ratio of at least 1 to 2. Think about it. If you risk $100 to make $200, you can literally be wrong 40% of the time and still come out profitable. Combine that strict math with healthy, consistent habits. Start small in a demo account, rigorously use stop losses, and keep a totally emotion-free trading journal. You know the saying, you can't improve what you don't measure? Wait patiently for the absolute best A-grade setups and treat margin purely as an execution tool, not a lottery ticket. And as your own operations begin to scale, you must refer to strict guidelines, like the ones set by the NFA, to know exactly what collateral can secure your margin. This entire space is highly regulated, detailing acceptable deposits ranging from US dollars to specific government obligations across different exchanges. You have to know the rules of the game. Ultimately, surviving this market all comes down to discipline. The goal isn't absolute perfection. Every single professional takes losses. But ask yourself, are you ready to implement these structural rules today? Or are you going to wait for a devastating margin call to teach you the hard way? Thanks for joining me on this explainer. Stay disciplined, stay sharp, and I'll catch you on the next one.